Uh, I think you'll find this very educational and helpful for you personally, as it has been for me. And here's a face with the voice. If I haven't met people on the webinar, this is me on the left, Levi, my beautiful wife, Chantel, who's a RN, and then we've got two precious kiddos, which keeps me working hard every day. Jaden, my 5-year-old on the left, and Jasmine, my 6-year-old on the right there. So, traditionally, banking has only been taught from generation to generation through avenues such as this picture here, from one parent to the next child. There's no major educational institution in the world that I'm aware of that is teaching people how to become their own banker. So that's why we find this a very valuable webinar for people to learn how to do these strategies. I was very blessed to be introduced to this book through my wife a little over 10 years ago. I was doing some financial planning for her family and pulled out her investment file and their insurance file and pulled out this book, Becoming Your Own Banker. And I asked them what it was about, and they said they didn't know because they haven't read it yet. But their financial planner keeps bugging them and telling them that they really should take the time out and read this book. So I borrowed this book and read it all that night, and I remember just being speechless and blown away with the simplicity yet the profound knowledge that's in this book. I'd never heard about how to become my own banker before reading this book, so I immediately chased down their financial planner, and he mentored me for a few years and got introduced to Nelson Nash through him. And Mr. Nash, the author of this best-selling book, is become a good friend of mine. He's on my speed dial, and we've done some seminars together. I've flown him out to Kansas City here a few times for our clients and to help further their education, and also have traveled around the country to see him speak at different events. So if you have not read this book yet, this is a must-read. It's a requirement for any good library. And I've personally read this book over 40 times so far, and every time I read the book, I learn something new, and it helps my roots of understanding to go deeper. So I highly encourage you to do so. At least read it a couple times. So you'll find that very valuable. You can buy the book through our office or through Amazon as well. We have a book selling company on Amazon called Real Wealth. So that would be probably the best price on Amazon. Okay. Now, one of my favorite simple quotes here, Warren Buffett said, "If poor people would just do what rich people do, they wouldn't be poor anymore." How about that for profound simplicity? So what do the rich people do? Well, most of them think like a bank and act like a bank and give themselves money that you'd normally give a bank for your personal financing. So we encourage you to do the same. After this webinar, hopefully you'll start thinking more like a banker, acting more like a banker, so you don't give them all of your hard-earned money. Now let's start by looking at the problem of interest that we're spending on automobiles, housing, living expenses, and then we work hard to save money at the end of each month. Well, this is the average all-American family spending these percentages on their lifestyle. But yet financing these automobiles, housing, and living expenses averages 34.5 cents of every dollar that we spend on financing. Okay, so I liken this to, if we compare the 34.5 cents to the 10% that we're trying to move forward, it's a lot like if we got into a canoe and the fastest that we could row that boat was 10 miles an hour. Yet we're going upstream into a current that's pushing us back 34.5 miles per hour. How much progress are we going to make in our financial economy? Well, so instead of making these interest dollars work against us, what if we were to just flip the boat around, so to speak, and go with the current? We can row 10 miles an hour. The 34.5 miles an hour is pushing behind us. Aren't we moving forward at 44.5 miles an hour instead of backwards at 24 miles per hour? Okay, well, we can do the same thing with our financial world. Interest is a lot like miles per hour in movement. It moves us ahead, or it gets us pushed further back behind. So how do we make these interest dollars work for us instead of against us? Well, first we have to acknowledge that everything that we buy, we finance. We either use loans, and we finance through traditional banking institutions, or we pay cash. And when we pay cash, we're actually giving up interest that could have worked for us. Okay, that's called opportunity cost. So how much profits do your financing entities share with you? I think if we're honest, most of us would say zero, unless we happen to be a stockholder in the exact same company that we're doing our financing through, which is usually not the case. So we're going to show you how to make this work for you. And we've got to look at the interest that we pay from a little different perspective than what all of our friends and family around us are talking about. Okay, most people are talking about rate of interest rates. The real issue that makes a bigger impact in our financial picture is actually the volume of interest that we're paying. Okay, for example, if we're financing a mortgage over 30 years at, say, 6% interest, the rate at which that is leaving our account is 6%. But the volume of dollars that we pay for that mortgage is closer to 90%. In other words, we finance a $500,000 property, we're going to pay close to $500,000 of interest for that property. So it's well over 90% of every dollar spent on volume of dollars for that mortgage. Okay, the average mortgage only stays on the books for 5 years, and then it's refinanced. So that continues to push, affecting the principal payments back further and further and further. Now, here's how a traditional bank works. Before you can even go into the banking business in the traditional sense of the word, you have to have $20 million in capital stock sitting at someone else's bank for a long period of time until you can jump through all the hoops with the banking commissioner. And then after you go through that long, tedious process, he will grant you a banking charter. And before you can start your business and collecting deposits, you have to talk customers into putting their deposits in your new bank when there's all these existing banks around. So there's a lot of time and cost in getting this established, but it is very profitable. That's why there's a line a mile long. And for every deposit put into your bank, how much can you turn around and lend out to the next person in line taking a loan? Well, it's not just that dollar of deposits collected, or $1,000 in this example. It's actually over $10,000 that you can lend out and put into the economy. Now, where did that $10,000 come from? The $1,000 deposit actually goes into what's called Tier 1 assets, which is governed. There's 4 different categories that we can put that money into that's governed by the federal government. And that's cash, treasury bills, precious metals, or cash value of life insurance. And then they can turn around and lend out 10 times the money that was put into that Tier 1 asset. And the answer is that $10,000 does not come from other depositors. It doesn't come from investment capital. It actually comes out of thin air. So the banks make their money by doing loans and making interest on loans. And the reality is this $10,000 doesn't exist. It's not backed by anything besides a $1,000 deposit. That's why banks are so profitable for one, but risky for two. So to mitigate that risk, they buy insurance through FDIC, Federal Deposit Insurance Corporation. That's not the federal government. That's actually a private insurance company that insures member banks of the Federal Reserve System. Okay, so many of you know this that are on the call. Many of you, this is new information for you, but check it out for yourself. The banks can actually create money out of thin air and lend it out into the world that's not backed by anything. Now, what's the definition of inflation? It is the increase in money supply. So what is the biggest instigator for increasing the money supply and inflating our dollars, making them worth less and less every single day? Well, you guessed it. If you guessed it's the banking institution, then you're correct. Move to the head of the class, because they can create money, put it into the economy. The more money that's out there, the less valuable it is. So that actually hurts our US dollar. Now that's traditional banking. Here's a example to show you how the money flows through the banking system and through the member banks throughout the Federal Reserve System in the country. Let's say you put a $100,000 deposit into the bank. Best case scenario, you might get 2% interest. Next person in line wants to buy a house. So they put that $100,000 into their Tier 1 capital, cash, treasury bills, precious metals, or cash value life insurance. And then they can lend out $1 million. So buying a house, they might charge you 7% interest. You pay cash to the seller at closing. The seller puts that cash back into the banking system. Next person in line wants to buy a car. The bank may charge 8% interest on that car note. They'll give the dealer cash at the final closing of the transaction. Dealer puts that cash back into the banking system. For a house remodel, say 9%, pay the contractor cash. Cash goes back into the banking system. Then debt consolidation. They may charge 12% interest on high interest credit cards like American Express, Visa, Discover, MasterCard, and then they put that money back into the banking system. Okay, now how much money did you get again? 2%? How much did the bank make off of this? Well, the spread on the house loan is 5%, and then the car, 8 minus 2 is 6. For the house remodel, 9 minus 2 is 7, 12 minus 2 is 10, and the bank made 28% just on the spread. Now, was that on their money or was that on your money? Yes, that was on your money. So you get 2%. How much, as a function of percentage, did the bank actually make? Well, it's actually 1,400% more. Okay, not just 26% more, but 1,400% more. And that's not on their money, but on your money. Now, do they do these cycles of loans once a year, once a month, once a day, multiple times a day? Well, you can see here how ridiculously profitable that these banking institutions are off of your money that's sitting in their deposits. Now, is that the process that you want to go through to control your banking needs? Well, here's something to help you make that decision. Here's the Sir Josiah Stamp. He's the president of the Bank of England in the 1920s and 30s. It's where the Federal Reserve System got our idea for the central banking concept from England. And he said that the modern banking system manufactures money out of nothing. The process is perhaps the most astounding sleight of hand that was ever invented. Banking was conceived in iniquity and born in sin. Bankers own the earth. Take it away from them, but leave them the power to create money and control credit, and with the flick of a pen, they'll create enough money to buy it back again. Take this great power away from the bankers, and all great fortunes like mine will disappear. And they ought to disappear, for this world would be a better and happier world to live in. But if you want to continue the slaves of bankers and pay the cost of your own slavery, let them continue to create money and control credit. Okay, now, I don't know about you, but I think we can agree this guy knows something about banking, and he just reiterated everything I'd said up until now regarding the banking system creating money out of thin air. Now, I don't want to go through that process for my banking needs, for my family and my businesses. In fact, I actually feel a moral obligation to do something different, to not participate in that game because of its corruption. There is a much simpler way. It's leveraging a financial vehicle that's over 200 years old. Traditional banks and corporations actually use this financial vehicle as a safe reserve to keep their wealth. And the banks use it to leverage. Corporations use it for future dollars for their owners and executives, and also for banking and borrowing. But it's a unique type of life insurance policy, not term insurance that has no cash and you're basically renting a policy, not a universal life type of policy that's a buy term, invest the difference, and it actually gets more costly every year with lower guarantees. But it's actually a dividend paying mutual life insurance policy. Now, this is kind of a unique type of vehicle because usually when people think of life insurance, they think of death benefits. Whereas the way that we structure these types of policies is lowering the death benefit, increasing the cash value accumulation for every premium dollar put into the policy so that we can actually earn a very competitive interest rate on safe money. So I'll go over with you why we're using this type of a financial vehicle and why the banks are using it and why the corporations are using it as well. Now, we put this chart together to let you know why we're using a dividend-paying life insurance policy, which we call at Clockwork Financial a clockwork policy because of the ways that we have maximized and structured these policies for our clients. But at the top of the list, these are general categories of where people will traditionally try to save money and grow money. Precious metals, annuities, CDs, real estate, stocks, bonds, mutual funds, and qualified plans. Now, we've asked over 1,000 entrepreneurs, what do you want your financial vehicles to do for you? So we have quite a few benefits here on the left-hand column, and this is the answers. This is what people have told us that they want. A competitive return, guaranteed returns, 100% insured, tax-deferred growth, and liquidity, use, and control of that money at the same time. Unlimited contributions as opposed to qualified plans, for example. Retirement income that's tax-free and sustainable forever. Judgment proof and creditor proof. If there's lawsuits, then the money would not be pulled into a court case. If we're disabled, then the insurance company will continue to fund the savings or investment amount that's set up to go into this asset class. A tax-free legacy that blossoms upon our death. So instead of having a couple $100,000 in a CD that's transferred to the family, that couple $100,000 would turn into $400,000 or $500,000 upon death. That's also tax-free, and the ability to bank off of this money while it continues to grow. Okay, so we've done extensive due diligence and research on this, and there is not a single asset class that has every single one of these benefits except for this dividend-paying mutual life insurance policy. Now, it's not a mutual fund, it's mutually owned. In other words, like similar to a credit union that shares their profits with their customers, a mutual insurance company does not have any stockholders within the whole corporate entity. They are required to share those profits with their customers, and in fact, only one type of customer. People who own term insurance don't get a dime of those profits. People who own health insurance or disability insurance or long-term care insurance, they don't share the profits with those customers, just the ones who have these dividend-paying mutual whole life policies. Okay, so if bonds had all these benefits that you see here on the left, then I'd be talking to you about how to buy a bunch of bonds and borrow against bonds and pay yourself back the interest that you would normally pay a bank. But unfortunately, bonds don't have all of these benefits. So this is just a summary here, why we put this grid together. Now, it's important to know that banking is not a product. It's a process. So we're not trying to just sell the next hot financial instrument out there and expect people to retire financially independent. Okay, in the same way that if you had a day with Tiger Woods, would you want to buy his clubs, or would you rather him teach you the swing? In other words, his process for being such a good golfer. Well, most people that think through that question would say, I'd rather know the process. I'd rather know how Tiger Woods swings that club instead of just thinking he's got magic clubs. So through the rest of this seminar this morning, we're going to run through the process of how do we flow money the same ways that banks and major corporations flow money and make profits off of that flow. So insurance companies are just depositories for the most part, same way that banks are. They collect money, they accumulate that wealth, and then they immediately look for ways to lend out that money and make a profit off of those loans. Now, banks call those that collection of money deposits. Insurance companies call that collection of money premiums. So they collect millions and millions of dollars, and they look at joint ventures. They look at low-risk mortgages. They look at policy loans, and they'll loan money out and make a little spread off of each of those transactions. Now, the person who outranks everybody else to access to that money pool is you and I as a policy owner. If we don't use that cash in our policy, well, they'll move it through a mortgage loan or a joint venture, or buy more long-term government or corporate bonds to build up their reserves. Now, at the end of the year, they tally up how many of us as policy owners died, and they had to pay out death claims out of that money pool. Of course, they have expenses of running the company, brick and mortar, utilities, and salaries. But everything else that's left is considered profits, and a stock company would send those dividends to their shareholders, not their policy holders. With a mutual insurance company, they send those dividends to you and I as a policy owner. And the best way to continue to build our storehouse of wealth inside of these banking policies is to reinvest that dividend into more premiums, i.e. deposits, into this money pool that is managed and controlled by the general account managers of this money pool. However, you control the amount of cash that's in your policy. Now, my mentor, Nelson Nash, I asked the most policies that he was up to was 48 of these things. But the very first policy that he got, he was a 28-year-old young man in 1959, and he was putting in just a small amount of money, which back then was a bigger sum of money, but just $388 per year. And you see here, starting from 1990, there's three different ways that the additions to the policy is calculated here. The first one is in green, the premium is the $388 per year. This is a unique type of policy because the premium never goes up. And it's the only type of policy that is like that. The premium's locked in and it's level. And then there's in yellow, the guaranteed cash value. That's the GCV. The guaranteed cash value is 4% tax-free. So worst case scenario, if the company did not make any profits, which never happened with any of these companies that we've been using for over 100 years, if the company never made a profit and didn't share the profits, then the cash value would get at least 4% tax-free. Now, that would be equivalent to, say, around 6, 7, 8% in a taxable account guaranteed every single year. And then the blue column here is the annual dividend. This is the share that Mr. Nash got on this policy in 1990. It was about $2,000. And he only paid $388 into the policy that year, and they gave him back about $2,000. Now, how much taxes did he pay on that $2,000? You're right, zero. The next year, they gave him a little over $2,000. Okay, so every single year, these additions are added to the policy. This isn't a cumulative amount here that shows some of that account balance going down. That just means that the dividends were a little bit lower in the years that there was a slight dip. But he still got very generous profits from these insurance companies. Again, he's got over 48 of these. Last few years, he's been trying to gift them out of his estate to try to prevent the big tax, which is the federal estate tax for people who have done well at accumulating a lot of wealth. Okay, so that's how the policies grow every year, and that's just one example. But as Mr. Nash traveled the world teaching this strategy to people like me and people like you, there's a lot of skepticism because of maybe what we thought these policies were or what other people have told us how they work that just aren't true. But people would be real skeptical and say, I don't believe that life insurance would pay that much profits in dividends. That seems too much. And Mr. Nash, wanting to prove what he's been teaching, he called up one of his companies. This one happened to be with State Farm, and they have a mutual life insurance division. They're not one of the companies that we do the policies with today, but they are a mutual life insurance company. So he called him up and said, hey, for the next 3 years, instead of reinvesting my dividends, I want you to send me a check just for my share of the company profits. So here we have 2006, 2007, and 2008, and he paid his $388 premium, and they sent him back $3,900 approximately per year in his share of the profits, and again, income tax free. So he didn't want to just keep draining his dividends from the company. He wanted to keep reinvesting them. So after the third year, he had it switched back to reinvest. Now here's your all-American family putting a very small amount of premiums into this insurance money pool and complaining about it, all the while going outside of their assets, which we call the Great Wall of China, because you have to pay gatekeepers and toll takers every time you finance outside of your assets, and giving finance companies like GMAC $260 a month and bragging about it. Well, GMAC doesn't finance these cars for free. They'll charge a spread, which in this case would be about $30, and they'll pay $230 of that $260 that they collect back to the money pool that you and I would have had access to if we would have financed things a little bit differently here. So that $30, remember earlier we were looking at the interest cost of financing cars, living expenses, and homes. Well, that's where that 34.5 cents on the dollar adds up over time, is this little spread on financing. Now, our recommendation is to reverse the polarity. Instead of putting a small amount into life insurance and a large amount to the banking financial institutions, take the $50 for life insurance, add the cash flow for your auto financing, and that gets us at $310 a month. Now, did we change your cash flow a dollar? Not yet. We're taking that same $310 a month. We're just putting it into the insurance money pool first before we finance. Now, Nelson Nash talks about the human factors that will prevent people from being successful in becoming their own banker. It's not this process or this product that doesn't work. It's the human factor that doesn't work sometimes. But the human factor he talks about is he talks about delayed gratification, or Parkinson's law. Northcote Parkinson was a successful philosopher, and he had a couple different philosophies, one of them being that expenses always rises to meet income. Another twist on that is a luxury once enjoyed becomes a necessity. And another issue that he dealt with was procrastination is a deadly enemy of accumulating wealth. Or excuse me, not procrastination, but delayed gratification. That people will not accept delayed gratification. So by delaying this car purchase for just a few short years, we'll have the $10,000 that we would have financed through GMAC in our banking policy within this mutual insurance company. And then we borrow the $10,000 from our own company that we're a small owner in, go to the car lot and pay cash for the car, still getting the best price, which is the cash price, not the 0% financing price. And then setting up a loan repayment schedule, which Clockwork Financial helps our clients do, making those repayments back into the money pool that we're an owner in. So instead of giving GMAC $260 a month, don't you like your assets much more than GMAC's assets? And don't you like your family bank more than another family bank? So we increase that monthly payment. Instead of $260 a month, we'll say $275 a month. What we've done here is we've forced ourselves to have a more profitable loan and forced ourselves to profit from 100% of that increased interest payment. So you can look at it like forced savings. You can look at it like a more profitable self-financing loan. Either way, it's capital in your account. Now, there's only 5 ways that we can finance anything in our life, and we talk a lot about financing cars because we all drive cars, I assume. But there's actually 7 ways to drive a car. Either someone gifts it to you or you steal it, but those 2 aren't the most common ways to do things. So we'll talk about the most common 5. If we lease our automobiles, that's the most expensive way by far because the person leasing us the car isn't a fool. They're going to charge us more than we would pay them, than they're actually paying for the car, thus making a hefty spread on that leasing transaction. And usually they're upside down on the lease anyways, as far as the number of miles that you can drive on that lease. Financing through a traditional bank is the next best way to finance automobiles, except we're giving them all our principal and all of our interest. Cash is the next best way to do things. Okay, so most financial gurus that we read about in some popular media shows, TV, radio, and books say that the best case scenario is you get out of debt, pay cash for everything, buy mutual funds and term life insurance, and when you retire, you don't need any more life insurance, and your mutual funds will generate enough income to pay you a monthly income for the rest of your life. Well, that may work for a very small percentage of people in the world, but I've been doing this 14 years and sat down with hundreds and hundreds of individuals, and things do not pan out the way that they anticipate them to pan out most times. People do not usually sit on the same mortgage for 30 years. People do not typically lower their lifestyle when they retire. In fact, a lot of people I meet increase their lifestyle because they want to do more traveling or help their family or grandkids with different financing opportunities. Maybe they're starting a business in their retirement years, which requires capital. Maybe they've done really, really well and they have a lot of wealth. The best way to transfer wealth by far is through life insurance. It bypasses probate. It's liquid. You don't have to fire, sell real estate, farmland, investment properties, or businesses to pay the estate taxes upon death. So a lot of our clients that are in their 70s and 80s that have done really well, they're actually looking to get more life insurance that will be there forever instead of renting it for a few short years. And the reason for that is to provide liquidity upon their death and get the government out of their hair so they can transfer their assets. Okay, so all that to say that the cash method is good for short term. Long term, it's not the best way to finance. There's 2 ways to finance that are actually profitable long term. The first one is called the CD method, and this is very simple. You just buy a CD at your bank, and let's just call it a $10,000 CD. And the banker today will give you about 1% interest. And he'll charge you about 2% on a collateralized CD loan. Okay, it's 2 to 3% interest. So he'll charge you a little spread on that loan and then give you the cash, but the CD continues to earn interest every single day, whereas your loan goes down to 0 over the term of the loan, whether it be 4, 5, 6 year auto loan. The dollars that you're paying on that interest actually go down every payment to 0. So the question I ask people when I'm talking person, face to face, is can you ever borrow money at say 6%, invest it at say 5%, and never make any money? And 99 out of 100 times people say no, you can't. Well, that's because our logical linear thinking mind says, well, 6 minus 5 is -1. How can I ever get ahead losing 1% every year? Well, if we extrapolate that out for 10 years, 20 years, 30 years, this is a 44-year period of time, that interest actually compounds every single day, and the dollars that that bank is paying you on that interest gets bigger and bigger every day. whereas the loans that you're paying on a 6% loan actually go down every single day. Okay, so there's a crossover point to where once that asset continues to accumulate, the same bank is paying you more dollars in interest than you're paying him on the loan. Okay, so we can go through more detail with you if you require, but that's what the CD method is. You're borrowing against a safe asset, and then you're paying the financial institution back, and that asset will continue to grow more than the money borrowed. Okay, now the last method here is the IBC method, infinite banking concept. And instead of putting money into a CD and borrowing against that CD from the bank, you're doing the same process. You're just using a properly structured permanent life insurance policy. And with that institution, the interest rate is higher, it's tax-free, and they actually share their profits with you, whereas the bank pays lower interest, taxable interest, and no dividends. Okay, so I'm not even counting the death benefit here in this example. I'm just talking about pure cash available to your fingertips over a 44-year period of time. Borrowing against a CD will be about $260,000 cash in your pocket. Borrowing against your life insurance policy is over $900,000 at your fingertips, not counting the death benefit. Okay, so those are the 5 methods of financing. Cash is best short term, like if you're looking at, just looking at 5-year window. If you're looking at beyond 5 years, 7, 10 years or more, the IBC method will definitely be much more profitable for you and your family. And it teaches your kids and grandkids and future generations how to build long-term safe wealth, income tax-free as well. And if you have the book, Becoming Your Own Banker, that chart is on page 41. And this year-by-year breakdown of the numbers is on page 45. I'm not going to spend time going through line item by line item today for the sake of time. And it's right in the book for you to analyze yourself. But what I do want to show you is the 4 basic phases of banking. You'll see here year 1 through 7 is deposits. And this is capitalizing the policy with premiums. And that's the first phase, is capitalizing the banking system. The second phase is we're looking at doing loans, eliminating debt that you owe other people, and taking that debt back to owning yourself. Now, it's important to remember here that banks' biggest assets on their books, by far, is debt. So debt is not bad unless you are the slave to the lender. Debt is good if you're the banker. Okay, so our process here is capitalizing a system that has enough cash in it to then eliminate the debt that you owe other people, bring that to the other side of the line, and then pay yourself those payments, turning your debts into assets and turning your expenses on those debts into an income stream. Okay, so that's the second phase, which is the lending process. Okay, the third phase is passive income. And the fourth phase is legacy transfer. Okay, so instead of just leaving the $1 million in the cash value in the life insurance, we're actually leaving the death benefit minus the loans. So we've pulled out $650,000 of loans over passive income phase. And the death benefit on this one policy is $1.3 million. Subtract the loans. So then we're still leaving over $600,000 to the next generation. No probate, no waiting period, and no income taxes. Okay, keep in mind this is a very small policy based upon our average, and it's only one policy. I've got 11 of these policies. I open up a branch office about once per year because it's a way to expand the banking system, and each policy will only allow so much cash inside of that policy before the IRS will say that's too much cash, and then that's the point where we open up another policy. Okay, so there is a limit per policy, and we've never had anybody convert a tax-free policy into a taxable policy. Okay, so far there's no questions in the chat log. So hopefully I'm not going too quick or too complex here for our introduction into banking. If there are any questions so far, please type those in, and that way I'll pause at the end and go over those questions. If not, then we'll let you go at the end of this webinar, and see you next week for our next week's webinar. So where should we keep our reserves? A lot of people keep their safe, liquid, emergency fund reserves in a bank savings account. I would encourage you not to do that anymore. For many reasons. One is you're not earning interest on that money, at least not very much. If you are earning interest, it's taxed. If you are earning taxed interest, inflation is eating away at the value of your dollars in there. If you're earning 1% and inflation's 4%, you're moving back at 3% every year. It's not a good way to move forward. So the other reason is that you are participating in the problem of making our US dollar worth less every year, because if you only have $10,000 in a a savings account at a bank, then you have caused $100,000 to be put into the economy that really should not exist. So I don't want to play that game. I don't do that myself. I just put enough into the bank checking account to cover my bills and expenses. My reserves I keep into what I'm going over with you today, into these policies. And it's for these reasons. No other safe place where we can keep our reserves have all these benefits. And I'm not the only one that's figured this out. And unfortunately, I can't take credit for creating or coming up with any of these ideas. I'm just a student of the game. And let's look at who else has actually figured this out. Well, Bank of America in their Tier 1 assets, and this is still a few years old. I need to update this from the last couple of years. But 2009, they had $137 billion in their Tier 1 assets. Okay, keep in mind they can lend out a little over 10 times that. Their holdings in cash value life insurance is $16.7 billion. And then as of 2009, $18 billion. And as a percentage of their Tier 1 assets that they put into life insurance, which is called BOLI, bank-owned life insurance, doing the exact same thing I'm showing you today, 13% of their assets. JP Morgan Chase, Wells Fargo, US Bank, you can see here, billions and billions of dollars into cash value life insurance for these purposes. But if you went into your local bank and asked your banker, hey, is it a good place for me to keep my safe savings account and cash value life insurance, they'd look at you like you're crazy and say, heck no, because they will probably lose a customer, and you wouldn't really need them long term anymore. Yet all the while they're doing this exact thing. Okay, let's look at a large corporation who used to be larger than they are today. But let's look at a 3-year window, 2005, 2006, 2007. These are the financial statements from Ford. And you see here that Ford is in 2 businesses, in the same way that I'm in 2 businesses, and in the same way I recommend every one of our clients to be in 2 businesses. The business that you are passionate about, that you understand, that you're generating your revenues from your product or service. Henry Ford happened to love cars because he was a mechanic before he got into the automotive business. But they later got into the banking business. So you've got Ford Auto and Ford Credit. 2005, Ford Auto wrote off $3.8 billion. All the while, Ford Credit made $4.9 billion profit. Wow, that's a huge difference there. 2006, they wrote off $17 billion in losses selling automobiles. Ford Credit made $1.9 billion profit. 2007, 4.9 in losses, 1.2 in profit. Okay, so 2006, 2007, their net income wasn't very good, but you can see that the banking business sure helped sustain them through and generate some profits at least. Okay, so again, in closing, this is a place to keep reserves, and keep your reserves in a safe place, and also allow the opportunity to borrow against that and grow it without paying taxes. And we're all destined to die someday. This is also the only place that we found that leaves a blossomed legacy benefit to the next generation without income taxes as well. So that's our overview on Becoming Your Own Banker 101. I'll pause for just a moment here. If there's any questions, please type that in the chat screen now. Still doesn't look like there is any questions. So hopefully everybody on the call has purchased their copy of Becoming Your Own Banker, read it at least twice. That book is really a manual written for the layperson like yourself. It wasn't written for financial gurus. It was actually written to supplement his 10-hour educational seminar, which he spends 2 hours on each part in the book, each of the 5 parts. So today's purpose was not to leave you walking away as a banking expert, but just to get you a high-level overview on why this is an important aspect to look at, especially with what's going on in our global economy, the devaluation of the U.S. dollar, the risk of hyperinflation, and bailouts, TARP money, and a lot of the bailouts and bankruptcies that we're seeing here. So if you're your own banker, that just minimizes your risk drastically. The book is $25. We do have a 10-book challenge where we encourage people who are getting excited about this as a solid strategy that we'll sell those books to you, 10 of them for $15 a piece. That way we can get 10 books in your hand and we can inflate education instead of dollars that don't exist and get people educated. The more people that are practicing this banking strategy, the safer our economy and country is going to be. The more dependent that we are on the mega banks, the more shifting sand that we're going to be building this country on. So you can call the office. We do take credit cards. You can mail in a check and request the book, or you can purchase it directly on Amazon from Real Wealth. It's not available in any stores because it's private published. You can pretty much just get it through Amazon or Nelson Nash's website, infinitebanking.org, or clockworkfinancial.com. Okay, we'll have a great Friday and a great rest of the year and great weekend. Enjoy learning how to become your own banker and schedule your consultation. Initial consultations, no cost. We can see if this is a solid strategy and if it'll work for you and how we can customize it to work for you personally. And next week, we are planning on doing a webinar, same time and place, regarding precious metals as a real asset to help hedge against inflation and hyperinflation, and also a solid currency for whatever happens with the economy. So thank you for your time. Have a great day, and we'll talk to you soon. Bye-bye.